Welcome, everyone. Scott Oeth, Cahill Financial Advisors. Excited to have another wealth strategy discussion, bringing in some interesting tax planning, wealth planning, financial planning topics, and certainly investment strategies. Some often we like to explore ones that are maybe a bit out of the mainstream and provide unique exposure, unique types of opportunities. And so with that, very excited today to have Michelle Butler, who is Senior Vice President with Cohen Steers, and we're going to be talking about real asset investing and investing in infrastructure. So unique exposure. This has been an area that I've been following for quite a few years. I actually went to a conference Cohen Steers put on maybe about 6-7 years ago, talking about infrastructure investing and really interesting opportunities and area of the market for a different element of exposure in a portfolio. So I think we're going to be talking about, why it makes sense and some specific market factors as to why it makes sense now. And then we'd love to hear a bit about the company in general. But of course, our favorite part, we always have to throw out our compliance disclosures to keep the powers that be are happy. So our discussion here today, we're just having a friendly chat. This is general informational and discussion purposes. This is not supposed to be specific advice for anyone who might be listening in. Please do your own research, seek your own specific advice. And like I always say, hey, give me a call at the office. We can talk about how this might make sense for you or not. But, with that, Michelle, maybe can you just tell us, what are real assets? What does that term mean? Your company likes to use as a general umbrella strategy, but you really have a lot of stuff in there when you're talking about real assets.
That's right. Okay. Can you hear me okay? I just want to make sure.
Yep, you bet. You sound great. Yep.
Perfect. Okay. So real assets are essentially the structures, the raw materials that help to facilitate global economic growth. So they tend to have, they're asset classes such as global real estate, global listed infrastructure, commodities, and natural resource equities. And those tend to comprise what we call the core four listed liquid real assets. They all tend to be very diversified. So very diversified under the hood in terms of sector and subsector and industry exposure. But I would say what really unites them under the definition of real assets is, again, they're structures that help to facilitate global economic growth. But I would say the main characteristic is that all have inflation beta embedded within them to different degrees, which we'll talk about, but they have inflation beta embedded within them. I would say that's probably the primary characteristic that really suits them or allows them to fit that definition of real assets. I would also add to that all four of those core four real asset classes, and you can see them here on the screen listed, also can be very diversifying to a portfolio. 3 of the core 4 are equities. Okay, so real estate, resource equities, and infrastructure are equities. But you tend to get a lot of diversification from those. In particular, I would say from infrastructure in the equity category. And of course, you get a lot of diversification from commodities because those aren't equities. Those tend to be futures contracts most often. And then the third aspect that I would say really unites them under this definition of real assets is that all of them can achieve an equity-like return, right? These aren't fixed income assets here. And I think that's important when investors think about asset allocation and what they're trying to achieve in their overall asset allocation budget is that you can get an equity-like return component. But I would say first and foremost, in order, inflation sensitivity and diversification, and then finally returns are what kind of lump them under this real assets definition.
Yeah, that's great. And I think that's an important point, like hearing about the equity-like returns over the long haul. Over the years, I've had many types of investment strategies pitched to me that people want me to put client money in. My inbox is full every day with these types of things. And often you hear about things like different hedge funds or liquid alternatives or things like that. And a big part of the pitch is it's a diversifying asset, non-correlated. These holdings don't move in the same direction as everything else.
Right.
So like that, that's an important component. We're thinking about building a portfolio. What's the volatility of that holding? how does it play with others? And we like things that zig when other things zag. But the piece that seems like it's often missing, either because just the asset class doesn't perform or the layers of fees and expenses, is that actual return.
Yeah.
So diversification is nice, but we don't want there to be a large opportunity cost of actually missing out on driving the portfolio forward. So that's, I think, a real key element with the components you've listed there, those four. Maybe one other thing, just to clarify, use the term inflation beta, sensitivity to inflation, right? That's one of the, what we call the Greeks, one of the measures of risk-adjusted return or portfolio variance. And so you're talking about these components have sensitivity. When there's high inflation, they tend to go up, right?
That's correct. That's correct. When you typically tend to see these asset classes, and actually, if we jump ahead, I think it's about 3 pages to page 9, I believe it is. There you go. Okay. So you tend to see, so these asset classes tend to perform well. And what do I mean when I say well? Well, relative to stocks and bonds, okay? They tend to outperform stocks and bonds when inflation is rising, which you can see here on the left-hand side, and when inflation surprises to the upside, okay, which you can see on the right-hand side. That's called unexpected inflation, when inflation prints come in higher than expected, okay? So here you can see the individual core 4 that I just walked through, the individual core 4 real asset classes in the lighter blue. And then you can see that combination, the real assets blend, in the navy blue. And of course, you can see that here's where you can see the relative inflation beta differences among the core 4. So you tend to get the most inflation beta from commodities and also resource equities. This data goes back to the 1990s. We can go back all the way to the 1970s as well. You'd have different numbers, but a similar trend. You tend to get the most from commodities and also from resource equities. And if you think about the underlying components, food and energy, so you'll have various types of metals, precious metals, industrial metals, you'll have energy. The food that I'm talking about would be agriculture, so you'll have grains like corn and wheat, but also softs like coffee and sugar. Cotton is the only one that's not a food that falls within that category. But you'll also include livestock like beef and hogs that fall within that category. And it can be very direct, the impact of inflation, which is why you tend to see higher inflation beta with those specific asset classes. You absolutely get inflation beta with real estate and with infrastructure, but it tends to be more indirect, still much greater than global equities and certainly than bonds. But it tends to be more indirect because it's typically based on the cash flows of those companies, where there's an indirect linkage, okay? Where, as an example, you could have for a toll road, which is a concession-based business, the fee for a toll road may change every year, let's say with CPI. And so that it's an indirect and not a direct. So it's important to understand those differences. But the main takeaway is you get significant inflation beta with these asset classes that you tend to not get with traditional risk assets like stocks and bonds. And thus you get that inflation protection, something that's been very much needed the last several years.
Yeah, very interesting. Interesting to hear you mention the 70s. Obviously, that was a decade where US equities did not deliver much in terms of capital appreciation, but we had high inflation. And so, look at real estate and commodities in a period like that. And in our role with what we do, absolutely think about this from a portfolio standpoint and, attractive long-term return, low correlation to other assets. That's important. But interpreting that into real lives is that financial planning layer, and taking a look at what do we need the portfolio to do for people, and critically, what do we need it to do for them at specific points in time to fund different goals or lifestyle. And having something, while we like to build a safety bucket of things like high quality bonds for near-term spending, at times I've definitely seen, as we've gone through periods like 2000 to 2002 or 2008 or 2020 or any number of years in between where there's different circumstances going on, having some type of holding that might do significantly different things. You can look and say, oh, wow, yeah, a lot of things are down, we have our safety bucket here to fund these goals, but look at this holding, which is very sensitive to inflation, for example, has had a really great pop. This is a great time to sell some of that and rebalance the portfolio, which we know makes sense long-term portfolio management wise, or maybe that's the attractive holding to go and take some money off of if we need to pay the tuition bill or the new car or or buy that next bond on the end of the bond ladder for safety money. So it's wonderful from our seat as portfolio manager and financial planner to have these low correlations and things that tend to really you talk about unexpected inflation that can put a downturn in stocks pretty quickly. But if this has a big upward move, can be an appealing component in the portfolio.
Absolutely, absolutely. And on that point too, maybe if you just go to the next slide, I think it's important because we're talking about diversification. This is a measure of looking at diversification. Here it's showing beta to global equities. This is an important point that sort of you just ended on, Scott, where at a 0.65, okay, for the blend of the core four assets, that's absolutely providing important diversification. But it's worth highlighting because you would not bucket these as defensive asset classes, right? This is not fixed income. 3 of the core 4 are equities and the other asset classes commodities. But you do get important diversification. So there is equity beta, and I think that's important. So you will capture upside as well when equity markets are doing well. But the key is the inflation beta, right? And this is a form of diversification. And at a 0.65, you're absolutely providing important diversification. Okay, so I just wanted to drive that point home as well. But maybe on your point, because you were talking about sort of the risk adjusted returns, and I think that's also important. If we jump one more slide, this visual helps to tell the story. So if you can read this, the chart goes back to also the early 1990s. What you're seeing here is on your x-axis is volatility or standard deviation, okay? On your y-axis, you have a nominal return. Each of the core 4 are plotted individually in light blue. So what's interesting about this is in some cases, as individual asset classes, they can at times exhibit more volatility than global equities. But look what happens when you combine them. You get a lot of diversification and you end up lowering your standard deviation, and that can be very attractive for an investor. Okay, so there are challenges. There can be challenges from an asset allocation perspective in determining when to own each individually. Like, how do I get the timing of commodities right? I know it's important, has the highest inflation beta, but how do I get that call right? We do that as experts, right? That's our expertise as a firm. But we put this portfolio together about a decade ago, and that in the real assets blend. And you can see when you combine these asset classes, and the table really demonstrates this all the way to the right in blue, you can achieve a comparable nominal return. Again, that's your equity, right? You can achieve an equity-like return. You lower your standard deviation, and you get a nice boost to your Sharpe ratio. That's an improved risk-adjusted return profile when you put the pieces together. That's what's really attractive to investors, right? And frankly, it's an easier way to get access to important asset classes that, again, serve a key purpose in a portfolio.
Yeah, this is a great chart. It's a wonderful example of potential diversification benefit from any number of assets, but these ones you have here specifically with a solid return on the vertical, but a much lower standard deviation. I think we've talked in the past. I talk with clients at times, trying to get too wonky on this, but the concept of variance drain, and what's often listed or noted is if you buy an index, this is your long-term return, but what's left out of the conversation is volatility, and both the real impact of that in terms of the actual growth of dollars, this concept of arithmetic versus geometric return. But in real life, say we're dealing with a retiree portfolio where we're needing to consistently send out checks, it makes a big difference if we're able to smooth out the ride with the diversification. So from a functional standpoint, that makes a lot of sense. There's also, Michelle, I don't know if you've seen this, but without a doubt, there's an investor psychology component here too. Like you mentioned, commodities. Okay, we may think commodities or real estate or natural resources, some of those components are attractive over the long haul, but sometimes the cycles can be long and they can be dramatic and they can be tough to own individually, and you can get investor fatigue. And we try and coach, we try and talk about this, but as opposed to saying it's in there, we have the exposure, but we're looking at the blended return, can, I think, let people have a bit more patience, where we know things will work out over the long haul and it's going to be a positive impact, maybe, as opposed to seeing those specific line items. And if one of those really gets dinged and has a bad year, you think, why am I owning commodities? They're terrible for this year or this 2 or 3 year period, but their blended impact in like as you're demonstrating here, it can be really powerful over the long haul.
Absolutely. A great example, there's so many good examples of your point there, Scott. So just think of last year, right? So last year, commodities were up around 16%. They were one of the few asset classes that was up last year in a down year when global equities were down 18%. That's significant dispersion, right? That's significant outperformance. Even real estate was down last year, right? As in real estate was down, infrastructure was down less than global equities, but infrastructure was down. So it really can serve as an important diversifier, and it can flip, it can go the other direction as well. So if you take investors are often accustomed to think, when you think about most recent history, right? In most recent history, the prior decade was a disinflationary period when the best performing real asset classes were real estate and infrastructure, and commodities was the laggard. Why? Because it was a market in oversupply, right? There's rationale behind that, where supply outpaced demand, right? That's not the case today. So there will be periods when these asset classes will outperform and underperform, and you get a lot of diversification through the benefits of the blend, right? It helps to keep investors subscribe to these important asset classes without having to worry about the individual timing, and sort of to rest assured that that exposure is there and it's being actively and professionally managed under the hood.
Yeah. Michelle, one of the issues is, this is nothing new. We've known this for a long time. In fact, I have a blog post with an ancient reference from the Talmud or something about the importance of diversification, and I forget it exactly. So, but for example, international stocks are a classic textbook example. If you go back decades ago to when I was in business school, you'd read this and say, international stock, their correlation is 0.8 to the S&P 500. But we've seen that change over time with globalization and trade agreements and technology. And the idea is that the correlation, the diversification benefit of something like international stocks has changed over time, and it's become less impactful. The other thing that we've seen is that in times of market crisis, in times of market turmoil, you can look at long-term correlation, but they tend to come together in these times of crisis. 2022 was one of the worst years ever for the classic blend of 60% stocks and 40% bonds. They both had a bad year. Yeah. I'm going to throw this one at you kind of the blue, but do you happen to know, or are there any information about how the correlation has behaved in different specific periods like that versus over the long haul? Any examples?
Well, it's going to depend on,
I guess you just gave 2022, which was a great example. But
it's going to depend on the asset class. So let's see. So we talked about 2022. Maybe another example, in recent history is 2020, right? So when COVID started. So if you think about the first quarter of 2020, all risk assets sold off, right? So that was very unique, right? That was not a financial crisis per se, right? Yeah. That was a global stoppage to mobility that was unprecedented, right? We never used that word more than we did that year.
That's right.
So it was very unique. So again, we can look back at history as a means to sort of learn from the past and sort of help prepare for the future, but no two periods are alike. And that was a really unique period where everything sold off. And I'll give you an example. So infrastructure tends to be a defensive asset class. If you look back through the history of this asset class, and you go back again 50 plus years, it tends to be defensive. So in times of crisis, it tends to outperform global equities. And we can see that consistently. 2020 was, first quarter was a period when that didn't work. And the reason why is because you had a global stop to mobility. And even though like utilities within infrastructure outperformed defensive, what didn't work was transportation. And when you think of an asset class like infrastructure, you have airports and marine ports, and you have passenger as well as freight transport. It was unique. But Scott, what was also interesting is that deep downturn was actually very brief, if you recall. So it was really March and maybe the beginning of April, if I recall. And then what happened? There was a very strong market rally.
Yep.
And if you had gone like to cash, right, or gold, you would have lagged in that recovery because there was a very strong recovery. So it's really interesting. I think when you think about, again, it's just driving that point home about diversification that you mentioned, really. But
Right.
another important example that's very, in recent history.
Right. So maybe talking about specific points in time. Thanks for the overview of what we're talking about here with real asset investing. I mean, why does this make sense now? We're looking, okay, we've had high inflation. Seems there's indications that it's slowing. Real estate has been very attractive over the long haul, but gee, we have rising interest rates, we have work from home, we have vacancies in downtown office centers. I mean, does this make sense now?
Sure. Okay. So when we're thinking about our outlook, so switching gears a little bit, because I think the first portion of our discussion was in sort of cementing the case for. So if we switch gears a bit and think about our outlook, I would say first and foremost, what investors often think about is valuation. So let's just start with valuation for a moment. When we look at these asset classes, and I think we have a valuation slide, I think it might be 14 or 15, maybe 15. There you go. Perfect. I think this is helpful. I like the visuals because it can help to kind of cement the points. So what we're looking at here is the core 4 asset classes that I described. So you have real estate top left versus global equities, commodities top right versus global equities, and so forth around the page. So the way to interpret this chart, so this is looking at standard deviation of performance over time, and it's done via a Z-score. So if you're below the 0 line in light blue, it essentially indicates that asset class is plotting cheap versus global equities, okay? If you're above the line in navy blue, you're expensive. So 3 of the core 4 are plotting, and this is actually as of December, I'll update you real time. So 3 of the core 4 here as of December were plotting inexpensive. The only one that wasn't was commodities, but commodities wasn't plotting expensive either. It was sort of on par with history, right? Today, all 4 are plotting inexpensive because they've lagged global equities year to date this year. So main takeaway, just from a pure valuation perspective, is these asset classes continue to screen attractive versus global equities. And I think that's just important when investors are thinking a bit more tactically for the moment with respect to, am I too late, right? I think that's a big question because of the performance discrepancy last year between global equities and real assets. You're not too late, right? They're still screaming inexpensive.
Things still look cheap.
Still look cheap.
Yeah.
So I would say that's one from a valuation perspective. But I imagine what's probably top of mind for you and investors is inflation. So if we kind of move forward and let's see if we can go to the next slide. I think that will work. 16. This is interesting. So this is a look at we use U.S. CPI and headline CPI as a proxy for global inflation, which tends to work in particular in developed markets. There's some history here. So the chart, as you can see, goes back to 2012 and it's updated through the end of the year. And then it gives some expectations, forward-looking expectations. So we know the history, right? The history is sort of in that red bar range where for a decade, essentially, we were in this disinflationary period where inflation came in below the Fed's expectation. It hovered on average around 1.85-ish. So very low, right? We were a bit spoiled during that period, for a decade, I would say. You didn't, I'm being a bit sarcastic here, but you didn't need to be diversified. Like the 60-40 portfolio, even Scott, the 70-30 portfolio would have worked, right?
Mhm.
But you don't know this, until retrospect. But it
Mhm.
was a unique period, and I kind of think of it as the Goldilocks period. Low inflation, low interest rates, equities kept hitting all-time highs.
Right.
You referred to kind of, uh, college accounts. We saw college accounts, 529s continued to go up, our retirement accounts, and so forth.
Yeah. Yep.
And then COVID
Yep.
hit 2020. You had the spike in inflation. That's what you're seeing there with the blue line. That's all known. What I think, Scott, is more interesting about this chart are the black dotted lines, and that's consensus forecast for where they thought inflation was going to go
Hmm.
and how wrong they were because
Mhm.
inflation kept going up, right? That's your unexpected inflation, right?
Mhm.
And that we saw that period with when real assets really outperformed. So what's happening now? So the expectations are still that inflation is going to come down, and we believe it absolutely will be. We think the Fed and central banks will be successful in bringing inflation down. But the key is that inflation is being managed lower,
Right.
right? By a very, very aggressive Fed and central bank policy action.
Right.
There's a lag effect to that action that we're starting to see, right? As we've sort of that hook that the inflation is starting to come down. But those secular inflationary signposts, those risks are still under the surface, and they present a real risk. And it warrants diversification, right? It warrants maintaining inflation beta in a portfolio. And I think another point, if we actually go to the next slide, slide 17, I think this is just an interesting food for thought side, because sort of a natural question you might say is, okay, so I know, and I know inflation's coming down because it's being managed lower, and it is. But sort of like if we look back in history, because again, we can learn from history, how many times has inflation been this high, right? We're in an extreme period. And what happened next? And there were only two periods in history over the last 100 years, only two periods, the World War II era in the 1940s and the 70s era that we just talked about, that really began in the late 60s and continued into the 70s. And what's interesting, if you look at when that high inflation was initially contained, and we're in the containment zone now in green, what happened next? There was a resurgence in the months and years ahead, displaying really the difficulty in containing such high inflation. And it's not our base case that we're going to go back to 9-10%, but I think this is, a really interesting chart to look back and say, you also can't rule it out. You can't rule it out. And if
Right.
policymakers aren't resolute enough, I think it's important to really stay diversified. And that's what sort of a chart or history is telling us.
Very interesting. Very interesting. Yeah, I mean, it can pop back up. It can reaccelerate. There's many people who say we may be solidly in a recession by the end of the year, and there may be interest rate cuts, and we'll really know when we see joblessness starting to rise. So, those things may happen, which might lead to interest rate cut or series of cuts. But then, who knows what 2024, 25, 26 brings as things reignite. There's still was a tremendous amount of liquidity put into the system that you say these things can take quite a while to work out. So
that's right, and those inflationary risks are still there. So if you think about the prior decade compared to where we are today, in the prior decade, again, I had mentioned this, so low inflation, low interest rates, but it was more than that. The prior decade was marked by a period of oversupply, right, which brought commodity prices down. You had globalization where we had vast trade, and it was
right.
promoted, it was increased. You had growth outperforming value. It's almost the opposite of where we are today, meaning those risks, those inflationary risks are still there. And it's factors now, instead of globalization, it's deglobalization.
Mhm.
Or sometimes it's termed friendshoring, which essentially is trade partner selectivity, right? So
Okay.
maybe you're not trading with the lowest cost producer, maybe that's a Russia or a China, and instead you become a price taker. That's inflationary. You can see it with still tight commodity markets, right? Very tight inventories. Climate change is inflationary if it restricts supply. So lots of examples. The wage market, I would say that's probably the one of the most significant signposts that we're seeing. Very tight labor markets, very sticky wage growth. They
Mhm.
pose challenges for really managing inflation lower, and we continue to see that. So even though headline inflation has come down, core inflation, right? The Fed calls it the super core inflation,
Mhm.
remains
Mhm.
very, very sticky today.
Michelle, Cohen Steers is known really as a real estate investment company. That's the roots, and that is one of your core components of this type of strategy.
Yes.
What specifically are you seeing? Was the company and your analyst, your team seeing in terms of commercial real estate? What types of real estate exposure are we talking about? And what is the outlook? It just seems to be, I get a lot of questions about this. It's interesting. You see low occupancy, low rates of back to home in some major metros, and you hear about a wall of refinancing coming up and higher interest rates. And of course, here we are sitting here on Zoom having a great discussion like this across the country. We weren't doing this a couple of years ago. And I'd love to hear some thoughts specifically about real estate and valuation and outlook and what it's done historically and how you're thinking about it at this point in time.
Sure. So when we're talking about real estate, we're talking about subsectors and sectors such as industrial. So there's residential. There also includes retail, hotel, office. It's very diversified. Healthcare would fall under that bucket. Self-storage, even specialty. So it's very well diversified, as I think I've conveyed when it comes to sort of the different components. We do think there are favorable entry points for real estate right now for REITs. And we think they're emerging and it's sort of shifting in the current market environment. And I think that's key as well. So when we think about valuations, which was one of your questions, our outlook continues to remain positive. So we continue to see a deceleration in the Fed hiking cycle, and that will impact different asset classes differently. So I think that's important. But we continue to see as inflation continues to moderate and we near sort of that terminal rate level, labor markets remain tight, but we do think it will sort of weaken in time, and that's going to tighten, financial conditions. But I would say that the key points when it comes to real estate specifically is they have historically performed well in environments where values are discounted, right? And that's what the environment that we're in right now. As recession, if it becomes a reality and central banks near their terminal interest rate level, it really sets up, we think, a key entry point for REITs. So I would say that would be one factor. A second factor when we think about REITs is the fundamentals for the asset class continue to remain resilient. And even though financing costs are higher because we've been in a rising interest rate environment for the better part of the last 18 months or so, and growth will be slower, REITs typically enter this recessionary period in a position of relative strength. And that's what we're seeing now. And we think that can be further supported by tight supply and in select markets and also healthy balance sheets. So I would say that would be the second point would be that fundamentals remain resilient. And then maybe third would be, from just a kind of a thinking about valuations and sort of this new market regime, REIT valuations appear more attractive, and especially after the repricing that we've seen in response to kind of this higher interest rate regime over the last 18 months and an anticipated recession. So from a valuation perspective, and you saw it on that valuation slide that I showed you, valuations continue to remain attractive.
Okay. With commodities, you mentioned futures. Is that primary exposure you advocate? Are you buying companies that produce or have exposure? What are the vehicles, or is it primarily futures that you're talking?
Yeah, great question. So of the core four,
Mm-hmm.
two of them, one is commodities and that's futures, and the other one is resource equities and that's equity. So it's essentially the producers of the underlying equity. So two very different asset classes. They similar, but they actually are quite different. One, commodities are a spot asset, the futures asset, where performance is largely dependent on the spot market, so current supply and demand. And then with an equity, in the case of natural resource equities, performance is largely driven by investor expectations of future cash flows. So different asset classes.
Mm-hmm. And how much, I mean, we've had supply chain crises, then oversupply, and now, significant war in major commodity region. What are your thoughts in this point in time and some of those factors at play? I mean, commodities itself is a very broad term.
Yeah.
Any themes that you're seeing or stories in that category?
I would say so. Probably the most, I would say energy is a great example of kind of in a very quickly evolving market. So, and it's going to vary depending whether you're talking the commodity or the equity. But if you just think about energy markets, we started the year in oversupply, right? And that was a bit of I would think a shock to some, considering, we had very tight markets, certainly in the first half of last year, of 2022, and that was propelled by the war, the Russia-Ukraine war, where markets really tightened. But markets began to loosen, both in natural gas and in petroleum, in oil markets in the fourth quarter. And much of that had to do with warmer weather, and that was to the benefit of areas like Europe from a humanitarian perspective, frankly. But you had warmer weather and you had more commodities, energy commodities in storage. And so that caused prices to decline. So our outlook for energy to start the year was more bearish, and that was reflected in positioning. And mostly you would see that in the commodity side. However, our outlook, our projection was that markets would begin to tighten in the second half of this year. That was very recently accelerated with OPEC Plus's decision to take barrels off the market. And they had a surprise meeting about 2 weeks ago now, where they cut over 1 million barrels and they took it off the market, right? That announcement really gave support and helped to find a floor in prices. And you have Brent in the 80s today. WTI is just slightly below that. So that has shifted markets, where markets had quickly moved to be balanced. And we believe they will move into a deficit much faster. I bring that up because it's a very fluid market, and energy markets tend to be top of mind when investors are thinking about commodities, and they comprise, obviously a significant portion when you think about 30% of the commodities market itself. So that's an area where we started off a bit bearish and we have become increasingly bullish.
Interesting.
Yeah.
Any long-term thoughts? There's big general discussion both in the investment realm, political realm, across the board about movement towards renewables and green energy and things along those lines. I mean, how are you seeing the mix from an investment standpoint?
Sure. We have a lot of discussions on this, a lot of analysis. So the term energy transition has been widely adopted for quite some time, right? And that's true, right? There is a transition happening. But there's a term I prefer to use, which is called energy addition, right? And I think when you think about what's occurred, in particular, what's come to light over the last several years, when you have climate crises, right? When you have extreme weather patterns, and like extreme cold, polar vortex, and where you actually see in Texas windmills freeze, right? Which was unheard of prior. or you have wildfires in California, right? Or you have extreme heat waves in Europe, like we saw last year for the
Yeah.
last few years, right? What we realize is while the world continues to move to incorporate more renewables, which is why I say addition, we will continue to add to that. There's a pace at which that needs to happen, right? And I think traditional fossil fuels and renewables deserve a place. And I'm saying we, right? And we're seeing the recognition of that because if you don't move at that proper pace, you can see the results with, in particular, we've seen it the last 2 years in Europe with prices and the impact that's had on markets. And so there continues to be a transition, but I do like to think of it as an addition, right? As an addition, and there will be opportunities, and there will be challenges. And I think that also speaks to the importance of active management across real assets when it comes to that transition. And it doesn't just impact energy markets, right? It also impacts metals markets, right? That are used to promote that transition when it comes to EV vehicles and so forth. So it has a very broad impact across real assets. Real assets are key in that transition, right?
Yeah. Very interesting.
Essential.
Definitely interesting field to be just seeing how things unfold over the next 10, 20 years will be something. I do want to come back to real estate for a moment because I get this question from time to time, and I have my own answers and thoughts, but I have clients who maybe they have a vacation property, okay, or they're snowbirds with multi-state residents, so they own a couple properties that way. We have clients who own rental real estate like duplexes or apartment buildings, office buildings. We have quite a few clients who have farmland here in the Midwest that they've inherited or in a family partnership. You mentioned storage. We have one fellow who's really big into mini storage warehouses. When you're looking at something like that in their personal balance sheet, they may say, well, I have enough real estate, and we're certainly thoughtful about concentrate positions. We do a lot with executives who have large blocks of single stock, but an asset class like real estate, what about, owning a couple rental properties in the Minneapolis area versus having a slice of exposure to the type of real estate allocation, in a fund like this? What would you say about that?
In terms of from a regional perspective?
Well, just regional and maybe the specific types of properties. I think it's the ability to have exposure to things like data storage centers and communication towers and healthcare facilities. And, it's just a much broader real estate footprint. The whole diversification story, I guess, is where I usually go with this. Well, yes, we want to be thoughtful and sensitive, but the real estate market itself doesn't all move at once, right?
Absolutely. And there's lots of examples of that. So if I just think of like the UK market. Mm-hmm. So generally speaking, if I think of the UK market, we favor logistics in that specific market, logistics and self-storage. There are certain office landlords that are attractive that we like in that area that we may be underweight in other regional areas.
Right.
So I think that's a really good point. So this is each of these are very diversified asset classes. And in the case of, because we're talking real estate, very diversified at the regional, at the country, at the sector, subsector, and industry level. So as an active manager, we will have different views based on valuations, based on fundamentals, based on the macroeconomic environment in that specific region that will influence how we're positioned. So generally speaking, we tend to have, another example is a fairly cautious view on retail, and a lot of that is due to the damaging effects of e-commerce. So that's fairly consistent whether we're talking about the UK market or the US market. But there are areas in Asia Pac where we're a little bit more favorable, right? So we think about that with respect to our relative positioning, and it's reflected thus in our portfolio.
Right, right. Well, Can you tell us a bit more about your team and the company and the approach? They say a storied name in the investment field, particularly when we think of real estate investing. Cohen Steers comes to mind, but I think it's always impressive to see the amount of talent in the history and the folks you're working with.
Sure. So our history dates back to the mid 80s, and we did start as a real estate company. Sort of earned our brand and our reputation in real estate, began in US real estate, expanded into global real estate. We launched preferreds several years after that, and then with a very deliberate purpose, really wanted to diversify across broader real assets. We dipped our toe and really expanded since then into the infrastructure market in the early 2000s. We now have almost a 20-year history in the infrastructure market. Expanded in about 2011 into broader real assets, so resource equities and commodities. So today we are truly a global specialist in all of real assets. Okay, and you can see, so I see the team pages up here. A lot of that is shown on this page. So when it comes to this real assets sort of cohesive portfolio that we have, front and center in this page, because I know there's a lot of names here, is Vince Childers. So he leads that portfolio. He's the lead portfolio manager for our real assets portfolio.
He's the conductor.
Yeah, he's the portfolio manager. He has a team of analysts that work with him. I would focus at the bottom of the page. These are the individual real asset investment teams. So bottom left, we have global real estate team. I think it's fair to say we have the largest real estate team in the world. So tremendous amount of resources located in different regions and different countries around the world. Our commodities team, that was actually my background is actually commodities. So I came over with the commodities team in 2012. So I just hit my 10-year anniversary here. And we were part of a lift out. Yeah.
So I got to ask you a question.
Okay.
Trading Places, is it a great movie or is
Awesome.
it awesome? It's an awesome movie. Okay.
Yeah, that might have led to my interest many moons ago in commodities, right? Great. Yeah. We have our global infrastructure team. I work very closely with that team too. They're located in New York, London, Hong Kong, our resource equity team. And then we also have a fixed income team that helps us to manage the volatility, of course, in the portfolio. A lot of resources. Everybody is a specialist in their respective asset classes. And I would say, above all, tremendous amount of communication. So I'm in a lot of these meetings. We have meetings together, a lot of communication where we leverage the expertise within the team.
I see offices in London and Hong Kong. Do you ever get to go on the road and
I do.
get updates? Yeah.
Yes, I do. I was in London just about in February. I was in London for a week doing real asset and infrastructure meetings. So yes, I do.
All right, great. Well, I think this has been fascinating, very interesting strategy. Certainly when you look historically at the performance, which is key, the numbers delivered, but then also the diversification effect, which we love both as an asset manager and as a financial planner, like I say, interpreting the portfolio and the dollars into real world living. There's a great old economist saying you can't eat average annualized returns. And that what that's kind of pointing to is that volatility in a portfolio. And the more we can smooth that out and yes, try and achieve an attractive high long-term return, but really first and foremost, think about matching individual liabilities, those spending goals with the portfolio to make sure the dollars are there when we need them, but also over the long haul, smooth out the ride. It's a big win for us. So it's very interesting how you combine those. And it looks like at this point in time, you've pointed out some attractive valuations. So it's really something to keep our eye on.
Great. Well, thank you so much, Scott.
Yeah. Appreciate your time, Michelle, and look forward to talking again soon. If anyone listening has further questions or curious about how this might work in your personal situation, feel free to get in touch. So thank you, Michelle.
Thank you.